going to share with you some information about where the market is today. When you look back over the last year, 15 months or so, you would see the market has clearly gone up a lot. There have been a couple of corrections that are fairly minor, but in general it's gone up. So the question I have for myself and for you, where does it go from here? Does it keep going? We know it's not going to go to the moon, but does it keep going for a while? Or are we the market kind of burned out and it's ready to come on back down for a while before, some kind of a correction? And so I've got some information I'll share with you about that. Hi, welcome to my YouTube broadcast. My name is Ben Reppond. Today is March 12, 2024. I'm going to start with a piece from Jeremy Siegel, Professor Jeremy Siegel from the Wharton School. And he is distinguished, he's pretty well known actually, and I've actually played some pieces from him and followed him for at least the last year and a half. And during that entire period of time, he has been very bullish. And the market has corresponded to his calls. Well, you may look back and say, well, sure, of course, it did go up a lot, but that's in hindsight. You didn't know that a year and a half ago. And it was literally about a year and a half ago, September, October of 2022, when he was calling for, no, you need to get invested, the market's going up. And if you look him up, look up his videos, you'll see that that's what he was saying. It's been bullish ever since. The market has corrected a couple of times, nothing major. And he has stayed with his prediction. At the same time, others, some of whom I follow and think highly of, have been calling for a correction. Matter of fact, most of them have been calling for a correction, that the market is overbought and is going to go back down. That has not been the case. So my credit to Professor Siegel for his accurate predictions. He has his reasons, but those who think it's going down have their reasons too. But so from a standpoint of credibility and accuracy, I'm going to play this clip from him. Today, in the most recent 4-5 months, say 4.5 months, we have had a very surging market. And today, I believe we're at sort of an inflection point. Are we going to go higher from here, or is the market going to turn over and come on back down for some kind of a correction? I don't believe that it's going to crash, but it could come down for 5 or 10% or so, maybe more, in what area you would probably call a correction. So anyway, he speaks about this. I think it would give you some insight to the answer to that question. So take a listen to Professor Jeremy Siegel.
We got a lot to talk about, Professor, and it's great to have you on this Friday. So you're going to walk away to the weekend thinking what now about this rally?
Well, Scott, when you have trending stocks, when you have momentum stocks, there's a very old saying in Wall Street, and it is up the staircase, down the elevator. And if you take a look at NVIDIA and other trending stocks, that's what happens. Momentum players move on. They have very tight stops on it. As long as it's going up, they're there. And as soon as it breaks their trend line, boy, they're out. We have what's called a one-day reversal, new high, then low. My experience is that's rarely the final high for the stock. Usually you have a couple days, mixing on the price, and then it will resume its upward course. So this is something I've seen many times before, and does not scare me.
Okay, so the elevator goes down another floor or two, but then you get back on the escalator and you start going up?
Yeah, to consolidate. Yeah, that's exactly right. It's kind of like a head fake. I mean, playing the momentum play requires a steal, because when it goes down, it's so sharp. You say, "Oh, I'm going to get out," And then what happens, it goes back up to new highs, and you're so angry at yourself for getting out, you get on again, and it goes up another group, and then what happens at the very end, and I don't think we're at that very end, is you're saying, hey, diamond hands, I'm not selling this, it doesn't matter what. Unfortunately, that's usually the very top.
Well,
We're not
Professor,
there.
now you're using some of the lingo from the meme stock mania.
Yeah, I'm not saying they're meme stocks at all, because these are real companies. But take a look at what happened to Cisco in 1999 and 2000. I mean, this was a great company, got overvalued. But we talked about this last time. Could NVIDIA get there? Yeah, but it would be at a much higher price to get to what Cisco's evaluation was in 2000 compared to what NVIDIA is now.
Does it tell you, though, when you watch a stock like this go up seemingly every day, and it just reaches these heights that make you sit back and say, I just can't believe what this stock is doing? Does it tell you that there's just too much froth in certain parts of the market, but not the whole thing?
It tells me that we're beginning to get the trend followers and the momentum players. And they don't care what the valuation is. They don't care what the stock does. They don't care what the company does. They got their charts. They say, wow, with this trend over there, make the trend your friend. And I'm making it my friend, and I got my stop there. I'm riding it up. Everyone's convinced that they can jump off the train before it goes off the cliff. And I'm not saying that NVIDIA is at all ready to do that, but these are the games that speculators play, and I'm beginning to see more of those sort of players move into the market. But it's extremely early stage, not late stage, because 25 years ago, it had been going on for many years before finally it cracked.
But you're painting a scenario, though, in which exuberance starts to get a little bit irrational and then turns into pure euphoria, and that's when you have to worry. But you don't think we're anywhere near that stage yet?
Yeah, exactly.
What did you make of Powell on the Hill this week, who came off to many, maybe a little more dovish than expected?
Yeah, a little bit dovish. I mean, he said, and we're close. I didn't expect that. I mean, he could have shaded it to, we saw that January report, a little worried. It means we got a lot more work to go. But I think, maybe got some inkling of, a rather softish, good wage number that we're having now, and seeing some slowdown, saying, we are very, very close. I think next Tuesday's number, CPI, and which of course is going to be the last one before the March 20th FOMC, is going to be quite important. I really like to see a reversal of that from the uptick that we had in January, and I think that is definitely possible.
How many rate cuts are we getting this year, Professor?
Well, we talked about that. If we get too many, I'd worry, because that means the economy is crashing. So, you just say, oh, I just want as many as possible. No, you don't want as many as possible. And in fact, as Mike said earlier, it's much more important for the economy to stay strong than for us to have a rate cut in May or maybe June or earlier or later. However, I mean, I think my feeling is that we're going to have rate cuts. However, let me warn you, in how many days is it going to be? March 20th, 12 days. I think we're going to have less rate cuts on the dot plot than we did in December, because I think, honestly, Fed officials are surprised and pleased the strength of the economy, and they say, we don't have to cut that soon, and I can afford to wait a little longer before I can squelch inflation. So that might rattle the market a little bit, but it's only because of the strength of the economy, not because they're stubborn and won't do it beforehand. In fact, Jay Powell says, I'm not waiting until all the inflation is wrung out before I'm going to start cutting, which would obviously be too late at that point.
So recently I played a piece it was an interview that Melissa Lee did in Miami with the three traders who were in the movie The Big Short. And though this is a piece from them, not a host like Melissa Lee, but where they are talking about their view of the market. It's kind of being moderated by one of them, Danny Moses. And so he's asking the other two, okay, what do you think? Is the market going higher or is it going back down? Now keep in mind, these people are traders and they are shorters. They look for shorting opportunities, ways to bet against the market. So so he's asking them, okay, what's the macro view of the market? What do you think in general? So when he says macro view, he's really talking about indexes, the S&P, the Dow, the NASDAQ, et cetera, not talking about individual stocks. But what they want to go is they want to go into the individual stock area. And so I can't tell when they're happy about the condition of the market, what that means is it's overbought and ready for a short. You may think, oh, you're happy about the market because it's going up. They look at it the opposite. So be careful when you listen as to how you interpret any enthusiasm. But it was an interesting interview. But they do go into heavily, they want to focus on an individual stock. The stock that they focused on was Tesla. I went back and looked at videos, and you can check this out. Danny Moses has a video of about a year ago where he was he was disclosing that he was shorting Tesla. So if you look at the last year and he'll show you a picture of it, not very good at all. And so they have done very well. I don't know how much money or which ones of them are into Tesla as a short or others, but they do talk about that. So interesting view when you think of where is the market going from here.
Welcome back to another edition of What Are We Doing? Never has it been more relevant than right now. I want to welcome back Porter Collins and Vincent Daniel. And I want to just let people know the last time they were on in this venue was Thanksgiving. We did a special drop. A lot was going on then in the markets. And then we were all together down at the iConnections conference in Miami at the end of January. We were on a panel with our former partner, Steve Eisman, hosted by Melissa Lee. And then we were on Fast Money. So it was great to get together. So we've been sharing some thoughts out there with the public, but it feels like right now, we're certainly always feels like we're at that point. Feels though right now more relevant than ever. So I'd love to start out by just getting your guys' kind of current thoughts on the macro, and then we're certainly going to dive into some single names as we go on. So Porter, we'll start with you here. Give me your thoughts here.
Well, everyone thinks of us as three bears, and we've been big short guys and stuff like that. But the one short that we've been continuously pounding is Tesla. And Tesla is, I believe, rough math, 10% below the October lows, whereas the S&P is up 23% from the October lows. So, I'm not victory lapping or anything, but we've been right to be bearish on a certain car company. So
how does that fit into your narrative on the macro? Is it that the macro's started to become or is becoming more stock picking by the day? We're starting to see what was the Magnificent Seven is now whatever we were calling it, the Fab or Fantastic Four. At some point, just got to ignore those four and go invest and buy and sell stocks that are other 496. So within that macro context, what are the drivers that you guys are looking at?
I actually think it has nothing to do with the macro with respect to Tesla, because if you think about it, we've had a tremendous easing of financial conditions. So you would think a name like Tesla would be up significantly more, or up in general, rather than being down. I think it's an acknowledgement of the market, which is a good thing, at least from market participants, that fundamentals do matter. And as a result, why is Tesla down? Well, Tesla's down because the earnings expectations of this company have come down by a tremendous amount. And so as a result, I think people have choices to what they want to do with their money, particularly when they think about mega cap companies, to overweight or underweight, let alone go long or go short. And as a result, Tesla is the one they're choosing not to buy, or choosing to underweight, or quite frankly, sell. So that makes a lot of sense. I don't think that has to do with a a macro top-down thing. I think it's more of a single stock.
So here's another view. This is Jan Hatzius, the chief economist for Goldman Sachs, and he is proposing, believes that the Fed is going to have 4 rate cuts this year, beginning in June. He may be right. I don't know. There are people who think that we're probably not going to have rate increases, but that we will not have 4 cuts, maybe have less. But he's saying 4 cuts. And if so, there's got to be a reason to have those cuts. There's got to be an economic reason. But the net effect after we get 4 cuts, it should be, which is what he's betting on, a stimulus for the market. Good news for equities in 2024, if he's correct. So take a listen to Jan Hatzius.
Goldman Sachs chief economist Jan Hatzius joins us here at Post 9. Are you still at 4 cuts? Because now that's more than the market and the Fed expects.
We are still at 4, and I would say that at the margin, the news flow, I think, has said they're probably not too far from cuts. Yes, a little bit hard to know how much weight to put on Chair Powell's comment in the testimony, but it pushed in a slightly dovish direction. And if I look at today's jobs numbers, they certainly say that the labor market's very solid and payroll growth is still strong, but there's been a little bit more slack. The household survey and the unemployment rate are a bit softer, and the wage numbers also retrace that big increase that we saw in January. All of that to me says we're still on track for a soft landing with some gradual rate cuts as we go through the year.
We're going to get CPI next week, and then we have a Fed meeting, which nobody expects them to do anything for the March meeting. But I wonder how you expect the data to shake out from here on employment and inflation, because it feels like they don't really know, and they're waiting to see that too.
Well, we never know what the data is going to bring, obviously, but I think the inflation numbers will show much softer sequential numbers in the next couple of months than January. To us, January is really a huge outlier to the high side, driven by what we've termed a January effect, which is basically big price increases at the start of the year that are hard to seasonally adjust in a post-pandemic environment. And then this big increase in owner's equivalent rent, which to me looks like an outlier. So with that, I think the next couple of reports are going to look a lot better.
So finally, I want to play a piece from Cathie Wood, the CEO of ARK Invest Funds. And I know not everyone is a fan of Cathie Wood. I happen to like her. I think she's in an interesting space. She's in the innovation space, which is highly volatile and it's high risk. Emerging companies, I won't say startups, but early stage companies. And she's full of insights. And I know that not everybody agrees with her. So, but at the same time, I'd say she is smart. She is on the cutting edge of innovation companies. And so I appreciate her perspective. So yeah, I collectively add all of these together and then formulate my own view. She's going to talk about the economy, interest rates, and jobs. She thinks that interest rates are going to fall, inflation is going to fall, and that unemployment is probably going up to above 5%. Regional banks will struggle not only because of the office refinancing and bankruptcies probably, but also apartment buildings as well. So take a listen to Cathie Wood.
Let's talk about the economic backdrop, because your roots, right? When you started out, you are an economist and you think about things, the macro environment, the jobs report today, some strength, maybe some concerns about things starting to slow down. What does the U.S. economic environment look like to you, the business environment as well, and what it means for some of your investments?
Sure. It looks like that corporations are losing pricing power, and we are now beginning to see the unemployment rate move up. It went up to 3.9% in this latest report, from a low of 3.4%. So undeniably, it's on its way up now. And we do think it's because corporations are losing pricing power, their margins are getting hit. It's going to cause a couple of things. One, the labor hoarding that we've seen since COVID is going to diminish, and that will increase the unemployment rate. But then the second thing is it will accelerate the adoption of technologies. Innovation solves problems. And one of the things that it does is increase productivity, increase efficiency, and create new products and services. So we're pretty optimistic about our strategy in this environment because interest rates should come down. I think that the Fed, even the Fed, is going to be surprised at how low inflation goes. We think it could be negative this year.
Well, so Cathie, let me ask you that's interesting. I mean, if the expectations, at least according to traders right now, is that the first rate cut comes in June, is that too late in your view for the Fed to start cutting rates?
Well, I think the 24-fold increase in interest rates in little more than a year has shocked the system. We're beginning to see a reverberation of the regional bank issues. We don't think they are going away. Deposits are still outflowing broadly from the banking system. And there are increasing problems with commercial real estate. Most people know about the office problems, but multifamily units, multifamily apartments, we're beginning to see some distressed sales there as well. So I think that problem isn't as well understood, I think, and it's going to cause the regional banks even more problems.
And finally, I wanted to comment that this last week I was invited to be interviewed by Mike from Parallel Systems, which is a financial blog in Europe, and I'll post a link to it, to the interview below if you want to watch it. But I appreciate Mike for inviting me and doing a wonderful interview. Thank you for watching. If you have any questions or comments, leave them in the comment section below.